All right, welcome to The Explainer. Today, we're going to peek behind the curtain and look at the engine that runs modern markets. We'll be using Stephen Blyth's fantastic introduction to quantitative finance as our roadmap.
So let's kick things off with a simple question. It's actually a question that gets asked all the time in interviews for those high-stakes finance jobs, because it gets right to the heart of how this whole world works.
The answer feels pretty obvious, doesn't it? You take the dollar today. Of course you would. But why? Well, because you can put that dollar to work. You can invest it, even if it's just in a basic savings account, and let it earn interest. A year from now, you'll have more than a dollar. That simple choice, that preference for having something now, is the absolute foundation of all finance.
And that right there, that's the core idea behind what's called present value. It's basically the tool for figuring out what money in the future is worth in today's terms. I mean, look at that lottery example. You win $100 million. But wait, it's paid out over 25 years. With interest rates factored in, that prize is really only worth about $70 million today. It just goes to show you, money in your hand right now is always more valuable than a promise of money later. Okay, so here's where it gets really cool. Finance takes this simple idea and uses it to figure out the prices for all sorts of contracts about the future. And the amazing part? They often do it without needing a crystal ball or predicting anything at all. You know, there's this huge misconception that quants are just trying to forecast where a stock is going to go next week. But the reality is so much more interesting. It's less like being a psychic and more like being a detective, using pure, cold logic to deduce what something has to be worth. So, this whole logical machine, it all hinges on one single, incredibly powerful rule, the no arbitrage principle. All that really means is that there's no such thing as a free lunch. The market works on the assumption that any opportunity to make a guaranteed, totally risk-free profit will be snapped up and eliminated almost instantly. So how does that actually work? Well, if a price for something in the future is even slightly wrong, traders can literally build a risk-free money-making machine. Just follow the steps here. They see that a future price is too high, so right now, they sell that overpriced future contract, borrow some cash, and buy the stock today. Later on, when the contract is due, they just hand over the stock they already own, pay back the loan, and poof, they're left with a guaranteed profit. No risk involved.
And here's the kicker. Because everybody in the market is constantly hunting for these little opportunities, the second a wrong price pops up, thousands of traders would pounce on it, all running the same money-making play. That massive wave of activity instantly forces the price back to where it's supposed to be. You see, this is how the market prices the future. It's not a prediction, it's a logical necessity.
So this whole system sounds perfect, right? Almost foolproof. This elegant logic works beautifully, until it doesn't. That's because the real world can get incredibly messy, and the entire system is built on a few key assumptions that, well, don't always hold up. The 2008 financial crisis was basically a wrecking ball for these ideas. The models took a direct hit. The theory assumes you can always borrow money freely. But in 2008, nope. The money markets completely froze. The models assume markets are liquid, that you can always buy or sell. But then, liquidity just vanished. And the models assume you can always short sell. But then regulators stepped in and banned it for some assets. When these pillars of the theory crumble, the whole logical machine just grinds to a halt. And it's not just about a once-in-a-generation crisis, either. Markets are always pushing the limits. For decades, the idea of negative interest rates was considered, a theoretical impossibility. I mean, why would you pay someone to hold your money for you? It sounds absurd, but then, as this quote points out, it actually happened in Switzerland. Reality has a funny way of just ignoring the rulebook. All right, for this last part, let's talk about scale. We're going to see just how massive this world, built on this foundation of logic and assumptions, really is. And just a heads up, these numbers are going to get pretty wild. So, to get our bearings, let's start with a number that's huge, but one we can kind of wrap our heads around. This is the value of everything, all the goods and services produced by the entire U.S. economy in 1 year, about $15 trillion. A big number, for sure. Okay, so that's one country. Now, let's zoom out. This is the total value of every single publicly traded company on the planet. We're talking Apple, Google, Toyota, the whole shebang. All of it combined comes to around $50 trillion. And now, here's the big one. This is the scale of the market for just one type of financial product, interest rate derivatives.
The very contracts that are priced using the logical machinery we've been talking about. And the number is just staggering. $500 trillion. That is 10 times the value of all the world's stock markets combined. Just wow. Now, to be perfectly clear, this notional value isn't a pile of cash sitting somewhere. It's not the amount of money that could actually be lost. It's more like the face value of all these contracts. But what it does show, with breathtaking clarity, is just how deeply this mathematical way of thinking is woven into the very plumbing of the global economy. So what's the big takeaway here? Quantitative finance provides this incredibly powerful, super elegant, logical framework for making sense of financial markets. But it's a framework that is constantly bumping up against a complex, messy, and frankly unpredictable world. And the real question, the one that continues to shape our entire financial system, is how do you strike the right balance between trusting those elegant models and respecting the messy, unpredictable nature of reality?